penny stock that actually exploded like 1,600% after they announced a partnership with NVIDIA.
Beamr has been able to attract customers like Netflix, CBS, VMware, Walmart, and a lot of other big names. So it's really exciting, Kev. I'm quite interested overall.
They're issuing enough shares to raise 12, but probably more likely $14 million at $7. So it's almost a 30% discount to the market. So it's just such an aggressive discount. Hey guys, welcome back to the Beyond the Edge podcast. Today we're hitting a milestone. It's actually our 10th episode. So that's 10 episodes where we've covered over 30 different micro, small, mid-cap stocks. And we're missing Pete, our resident trend tracker today. He thinks that a holiday with his pregnant wife is a good excuse to miss the pod. We told him he better at least be spreading the good word of the pod wherever he is. But seriously, Congrats to Pete and Michelle. They've got a baby boy incoming, so a little edge analyst incubating right now. Fortunately, we got you. We got Mr. Fundamentals. Declan, what's happening with you? Anything cool happen in your portfolio this week?
Hey, what's going on, Kev? Yeah, no, it was a pretty quiet week overall. I mean, we got new inflation data, and of course, that's always exciting to watch as investors react and usually freak out to a couple of basis point misses. So I always enjoy watching how the market responds to those. But for myself, it was pretty quiet. How about you?
Pretty quiet, but actually, I don't know if you noticed, Bolero's gone through a bit of a ride since we talked about them. I don't know if you've taken a look, but like from January 31st to February 9th, it popped 40%. So that was around the time that we started talking about them. So, what's odd though is you could see earnings didn't come out till February 5th, and this big move started on January 31st. So it was like a very suspect timing for a move, which is very interesting.
Interesting. Yeah, basically what you're saying is that people should be paying attention to our picks then, hey?
Well, there's a few cool things that will tie into some news that are actually some former stocks that we talked about, like Recursion, that announced like some agreement with NVIDIA, or no, NVIDIA invested in Recursion. So there's a few good points we've had. Okay, well today we're covering a few cool things. So one, a penny stock that actually exploded like 1,600% after they announced a partnership with NVIDIA. Activist activist Carl Icahn, he bought a 10% stake in mid-cap company JetBlue. So we got into the airline we're talking about. Finally, Lyft, a mid-cap, just made one of the most epic typos you could put in an earnings release. Someone's getting fired for sure. We're going to make fun of them a bit and then dig into that. So if you're new, we do this every Thursday. We post it every Sunday. Look, let's just get straight into it, Deck. Let's get into this, man. So for the first topic today,
Let's do it.
You sent this over earlier in the week, and this was just like a mind-blowing piece of news. Like Beamr, this imaging company, and partnered up with NVIDIA, basically to accelerate the adoption of a new video standard called AV1. Something I'm wrapping my head around. I actually wasn't familiar with this at all, but upon the announcement, the stock shot up 1,600%. So just like an absolutely massive jump. I forget the exact details, but it took this from I think it was a 20 or 30 million micro cap to over 200 million. Real fast. So that was wild. Key points with this agreement. So there's a collaboration between Beamr and NVIDIA. It's looking to facilitate, like I said, the transition to this new AV1 format, which is more efficient, but there's a lot of challenges in adoption due to the complexity and the cost of upgrading existing videos. Number two, Beamr's tech, which is supported by NVIDIA's encoder. It offers automated processes to transfer video libraries to the AV1 format while maintaining quality, but compressing the size significantly. Number three, this proposed solution, the idea is to make the adoption of modern video formats seamless, cost-effective, yada, 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 make this a lot easier. So Deck, that was long-winded. I want to get over to you now and ask you a little bit about your opinion on this. So what do you think? How might the launch of Beamr's new video cloud service on Amazon AWS, which is powered by NVIDIA, how do you think that'll influence the accessibility and affordability of video processing for, I guess, both businesses and content creators?
Yeah, you know what, Kev? After diving into this business, I found it actually really cool, and also the business model itself quite simple to understand. So Beamr basically uses these AI trained computer vision processing to make videos smaller by up to 50%. And this leads to a lot less storage use, as well as the ability to move these videos across networks much faster. And this is all done while maintaining the video quality throughout. So just from that point, you can see how customers saving up to 50% on video storage is a huge value add. And if you've ever actually tried to create, upload, or store a video, you can understand what I mean when it is a pain in the butt. And this could be a game changer there. So kind of understanding how it works. Well, Beamr's algorithms basically make predictions on where human eyes are most likely to view the videos, and then it can remove various pixels within the video so that it focuses primarily on the key areas where viewers will watch it. And this allows it to compress it and ultimately make the whole amount of data that it takes up quite significantly less. Now, by partnering with NVIDIA, as well as like operating within AWS, the biggest cloud provider in the cloud video storage market, this makes Beamr's tech, or it really takes it over the edge by introducing the world's first accelerated video optimization platform with up to 10x performance. So what does that mean? Well, it's like putting Beamr's tech on steroids. With NVIDIA, Beamr can take on larger video libraries and make more of them using a lot less computer processing. This allows customers to compress these videos and transfer them a lot more efficiently. And it also speaks to why Beamr has been able to attract customers like Netflix, CBS, VMware, Walmart, and a lot of other big names. So it's really exciting, Kev. I'm quite interested overall, and I didn't realize how substantial this partnership would be, but I think this takes them to a whole nother level in terms of competitive positioning now that NVIDIA is a partner.
Yeah, super impressive company. They're an Israeli-based company. Obviously, Startup Nation is very well known for new emerging technologies. So very impressive. Surprised I'd never heard of it before. I was even seeing quotes of it being sometimes even more than a 50% compression in the file size. And when you think where everything's going with the amount of data that's about to start flooding our servers, once we really have spatial web coming into play, even just autonomous vehicles are going to create a monstrous surge in the amount of data that we need to process, and that we're not even well equipped to handle that. So technologies like this are wild. What blows my mind is how did this little $20 million Israeli penny stock, listed in the States, mind you, get this kind of agreement from, there was such a small company. Like they did about $1 million revenue the year before. They're a net loss company. Like in the last 6 months, it was $1 million revenue. And at the end of the day, they lost about $1 million. So for an R&D heavy tech company, it's really not a big loss, nothing to be scared of. And then they're able to get this NVIDIA partnership, which I honestly think what mesmerizes me the most out of this is the fact that NVIDIA allowed them to use their name in the press release, because a lot of these big companies are very tight-lipped about that. So I wonder two things. One, is there going to be a press release, some kind of retraction or something in the next couple of days, or are they just going to get slapped on the hand from NVIDIA, which is possibly more likely? Or is there some deeper reason for NVIDIA wanting to be involved? Like, they just announced a public offering of shares at $7. I wonder, Think Equity's running the book on that one. I'd be super curious to see if there's any strategics like NVIDIA actually placing an investment into it. Super curious to watch that, see what happens.
Yeah, no, big time. And I think like you nailed it on the head, Kev. I think it's important for viewers to really understand the whole dynamic of Beamr and where this all began. So they really started building this technology about 12 years ago and have built up their patent portfolio to over 52 recognized patents. And then from the partnership standpoint with NVIDIA, they actually began their partnership in Q1 of 2023. So surprisingly, there wasn't as much traction or noticeability back then. Of course, now things have kind of really panned out, but the partnership itself has been developing over the past year. And, if you're an investor looking at their historical financials, you might be scratching your head because you're looking at their revenue and it's kind of stayed flat, even declined over the past couple of years. And their R&D expenses really haven't jumped. I think they've even declined as well. So what I think happened here is that NVIDIA took on a lot of probably the R&D and integration costs associated with this partnership and probably deferred revenues over the long run. But I think what they saw and what is quite clear is that Beamr has some unique technology that provides a lot of value for these video organizations and even just individual developers themselves. But when you look at the whole cloud video storage market, it's expected to grow at about 16% annually and hit about 13.5 billion by 2025. Now, Beamr actually provides a really good outline of its business model, giving you a good insight into how they're expected to make money moving forward. And so basically what they expect is that out of a total addressable market of 13.5 billion, they are going to create cost savings about 30% of that, which it comes to 4.05 billion. And then from there, they're going to derive for every 1% of value added by the company, it equates to about $40.5 million of value. And Beamr's going to take a 1/3 cut on this. So you can expect that from a 1% value add, they could make about $13.36 million of potential revenue. And keep in mind, that's just 1% of value add. So really there's pretty big runway of growth here overall, it seems. And, clearly looking historically, the business doesn't seem to be in a great financial position, but having a player like NVIDIA take on those costs up front so that over the long run, this partnership can really develop and flourish is such an advantage that, I really never saw coming. And to me, it's just like, man, don't you wish you could have just got ahead of this and saw the partnership back in Q1 and jumped at this opportunity? So smacking my head for that one, but obviously in hindsight, it's always easier. So quite a cool partnership overall though.
You don't see moves like that often. Like that's the move of a biotech stock or like a gold mine or something. You know what I mean? To see such a partnership like that, seriously. I'm trying to think of how we would even position ourselves. Like I'd say we've actually held a few Israeli stocks over the years and seen some pretty cool innovation out of there. But to get ahead of something like this, I mean, I'm mad that we weren't there too, but man, good for them. I was actually contemplating if there's some way of getting in on this financing. It's Think Equity. I don't know anybody there. It's a US listing. I'd probably have to make an account. And I'm just a little butthurt because one of the biggest things I have against this company now is that they're issuing enough shares to raise 12, but probably more likely $14 million at $7. So it's almost a 30% discount to the market. So it's just such an aggressive discount that it almost feels like unnecessary. But this could be one of those stocks that I sit on the sidelines and I pout because I missed the financing, and then this thing goes to $30. You know what I mean? A 200 million market cap with a partnership in NVIDIA and a technology that is desperately needed. That I feel like I'm certainly not buying it today, but if I saw it dip a little bit more, I'd be pretty close to just throwing a flyer on this. You know what I mean? Put it on red.
Yeah, no, I second that. It's hard to realize the value of it right now just because we don't know how much they can actually tap on an annual basis quite yet. But it is, still sitting around $150 to $200 million market cap. Like you have to ask yourself, even with the jump, is there more growth ahead? So, and it seems like it is. It's just a matter of how long it will take to realize that. And so, like you, I think just keeping it on the radar and watching if there is a significant dip or an opportunity to get this at a meaningful discount, I think they're well positioned for growth. And they have the backing, and with potentially this additional capital as well, they're a lot better funded and financed than they have been in the past. So, a lot of positives looking forward for them.
Yeah, good for them. For the next topic I want to dig into is we're going back to airlines. So last time we were talking about airlines was Spirit with the door gate, whatever you want to call it, when the door blew off the airline and scared the crap out of people. Now we're talking about Icahn taking a 10% ownership stake in JetBlue. So I guess basically some simple terms of the deal. Icahn, he's built his way up to a 10% stake through Icahn Enterprises, which is a publicly traded company, just so you know, IEP, I think the ticker is. Take a look. He thinks it's undervalued. Following stock gains of 21%, Icahn plans to engage and discuss with the company about potential board representation too. That's part of the Icahn MO. He's an activist shareholder, if you don't know. Icahn's stake, it was accumulated through purchases in January and February, so pretty quick. And the intention is, he wants to get onto the board quickly, but let's see. Response, sounds like the company's open to it, but there's a lot we can dig into here because, his ownership of JetBlue, we can look at the fundamentals there, but this is not Icahn's first dabble into the airline space. Back in the 80s, he took over a I think it was almost up to, I think it came out to half of TWA. Um, I of course wasn't in the money game back then, but you know, considering Carl Icahn's history with the airline industry and previous investments like this, you know, Deck, what do you think are some potential challenges or improvements he could advocate for at JetBlue?
Yeah, for sure. So, I mean, first and foremost, if you don't know, Carl Icahn is known as being one of the most ruthless activist investors out there. He has a reputation for pressuring management, and when they fail to meet his demands, he doesn't hesitate to squeeze every dollar he can out of the business. You know, safely put, when Icahn joins a board, it's no longer the shareholders' company, it's Icahn. So it's important to keep in mind. And to really illustrate this is what you said, Kevin. So, you know, back in 1985, Icahn started buying more than 32% of this company called Trans World Airlines, which is a commercial airlines business. And interestingly, TWA tried to get acquired by another company, Texas Airco, for about $790 million to avoid Icahn's takeover. But it was actually TWA's unions that blocked the deal and supported Icahn's takeover deal instead. What happened from here is basically the corporate radar moved in for his final kill. First, Icahn appointed himself as the chairman of the airline. Then, in 1988, he took the company private, which netted him about $469 million, while TWA took on more than $540 million in debt. Shortly after that, in 1991, Icahn capped the company's growth by purchasing just 12 new aircrafts instead of the 100 needed to replace TWA's aging fleet. But it was what he did next that put the nail in the coffin. So in 1991, Icahn sold TWA's prized London routes to American Airlines for $445 million. These were the company's prized assets, and without them, it was a shell of itself. The next year, TWA filed for bankruptcy, and Icahn stepped down as the chairman in 1993. But he wasn't finished yet, because demanding that he gets paid from TWA's execs, they basically offered him a deal called the Caribou Ticket Agreement, which allowed Icahn to buy any ticket that connected through St. Louis for 55 cents on the dollar and resell them at a discount for 8 years. It was later estimated that this deal alone cost TWA $100 million per year. So, you know, unsurprisingly, the company was in a lot worse position. They were losing money now, and in 1995, they filed for bankruptcy once again and eventually merged with American Airlines. So when you look at this thing, it's understandable why Icahn sees JetBlue to be undervalued. If you look at the company's price to book value ratio, it's just 0.75. And I use this metric purposely in this example because book value, or the shareholder equity, is equal to a company's total assets minus its total liabilities. So in other words, it is the value of the remaining assets after the company were to fully liquidate and pay off its entire liabilities. But since JetBlue's market cap value as of February 15th was just $2.5 billion, it's below the company's book value of $3.34 billion. If he takes over, Icahn could essentially liquidate the entire company and net himself a return of 34%. And given his track record, I wouldn't be surprised if he did just that. So, in other words, if you're a growth investor looking to take advantage of this opportunity now that Icahn's in it, I wouldn't expect for long-term growth, but rather for the business to be potentially liquidated, especially based on this TWA story.
Yeah, fair points, man. That was a pretty ruthless review of Icahn. Did you watch the Netflix documentary on him? It's good. Hey?
I haven't yet. No, tell me
about
it. Have you seen it? I haven't.
Oh, really?
No, sorry.
Well, just watch it, man. And to anybody watching this, you know, just go watch it. I believe it's on Netflix. I was like an airplane watch for me, which was ironic, but it goes through his career. And yeah, he has a mixed reputation, I guess you could say. But no, the guy is like, if there's one thing he's good at, it's making money. So he's certainly done quite well. But TWA was a flop. But one thing you missed out on that story is that actually the unions did him dirty. And like you said, they blocked the other, what was it, an acquisition from another company. They had an agreement with, like, you know, they had to take pay cuts, et cetera, et cetera. And they actually striked instead. So they were striking for a while. and they would even show up at his house and were like on the weekend and demanding to speak with him. Like it was a pretty messy experience. And oh man, like the story goes on and on and on. Like he ended up starting a training school for new flight attendants because to try to quickly replace the ones that were on strike in like real time, and obviously that wasn't kept a secret, so it made them even more mad. It was a nightmarish deal. So part of me likes to think that he's learned his lesson and he's not going to go quite as corporate raider. But you nailed it on the head by saying like the book value is so attractive to a raider just to strip and pillage essentially. But man, JetBlue's a solid airline. I hope that's not their fate.
Yeah.
I'd be curious to see maybe he
Seriously.
does strip down assets, narrow the scope of the airline, make it smaller so that they would allow for a merger with Spirit. Something like that I'd be curious to see. I don't know. I actually just thought of that right now.
Yeah, no, yeah, that's a really good point that I didn't think of as well, and it potentially would approve or incentivize regulators to look at the deal from a more optimistic lens. But like you said as well, I didn't actually realize that the employees went on strike and really tried to be a pain in the butt for him as well. But that's understandable. Your job is potentially on the line, and if you've been working for that organization for a long time, and somebody comes in and just decides that they want to take all the capital they can and squeeze out whatever money they can make, then you're gonna fight and do your best to stand your ground.
Yeah.
So selfishly, I look at it, the deal from Icahn and his history as well. I respect it if you are like a cold-blooded, money-hungry capitalist. And, even Warren Buffett used to do this back in the day. And I think that's actually what he was trying to initially do with Berkshire Hathaway. He just didn't have the stomach to let go of all these employees. But I mean, you really got to ask yourself, like, if you could buy a company outright and net a guaranteed 34%, would you do it? So, of course, there is the caveat that people would lose their job and a legacy business would be tarnished, but you have to weigh those metrics, and Icahn's in a position where he can take advantage of that.
Hmm. Hmm. Well, I mean, I used just looking at like a side by side of a few companies, United Airlines, Southwest Airlines, and JetBlue, just certain ratios. Well, for one, JetBlue doesn't make any money. It's, net income negative. It's a loss, whereas both United and West are profitable. And then you look at certain, price to earnings, obviously JetBlue, that's irrelevant, but it's only 4 times for United, 20 times for Southwest. Look at the return on equity too. 10% for Southwest, 41% for United, and in the negatives for JetBlue. So it looks like there's an attractive, corporate rating opportunity, but not necessarily like a fundamental investing opportunity that gets me excited.
Yeah. No, I second it, Kev. I think Icahn knows what he's doing here. And, like you said, maybe he can potentially position it to grow more effectively and have those insights. He's obviously an effective capital allocator and has achieved a lot of success. It's ultimately just trying to figure out what his intentions are here. There's clearly an opportunity either way for him to liquidate the business or, hold on to his 10% position, help bring in some, consulting and various different insights and potentially turn JetBlue's business around. But, overall, it's once again, just talking on the airline business, it's not necessarily the most attractive investment opportunities because there's just such a high cost to managing these businesses. And then ultimately, the products that you are owning, in this case, airlines, depreciate in value really quickly. So you have to try and squeeze out every dollar you can from them before the business or the plane goes bust. And for him, he knows that there's value, but for the person looking outside in, you either got to have your faith in Icahn or probably not look at this from a fundamental investment standpoint.
Yeah. I mean, I'd say the same thing. Maybe this is a small amount of the portfolio as a flyer, just based on what kind of turnaround he can pull off in the next year or 2 years. But long term, I'd be less excited about it. So we don't like airlines generally. So let's move on from that. I want to talk about Lyft. This is a very amusing topic to go over. So now Lyft did report its financial results for Q4 and full year 2023. looking at achievements such as record high gross bookings, highest annual ridership, steps towards profitability, keyword steps. The company's focus now on operational excellence and strategic initiatives puts it in a place for, well, meaningful margin expansion and positive free cash flow in 24. But it's the margin expansion that I can't wait to talk about because there's a massive typo in the earnings release. I've got a lot of key points. So I don't want to list everything to you, but let me just give you a couple. Gross bookings, $3.7 billion in the quarter, up 17% year over year. Obviously, investors are excited to see that kind of growth. Skipping through to, adjusted EBITDA, 66 million. So positive. Last year, it was down significantly, 250 million in the quarter. So obviously that's an improvement. But the key headline thing we want to talk about is that they said they were expecting a 500 basis point improvement, and I believe it was their EBITDA margin, when in fact it was a typo and it was supposed to say 0.5%. So absolutely so embarrassing of an error, and how a press release that important can slip through so many checks and balances with such a massive error and have to be corrected live on a conference call is beyond me. So okay, with that rant, Deck, I want to kick this conversation off. With their new focus on operational excellence, how do you see Lyft planning to drive meaningful margin expansion to hopefully achieve positive free cash flow in 2024? Because that's the key, obviously.
Mm-hmm. Yeah, I mean, first off, like you said, Kev, there was a couple of annual achievements or milestones that the company completed, and I think these will have a positive effect on margins overall. For one, the company delivered more than 700 million rides in 2023. They also developed a new payment plan for drivers that'll essentially give them about 70% of the ride fees after external expenses. They also introduced this thing called Women Plus that essentially allows riders, to connect with women drivers, and just increasing the accessibility overall from that standpoint. So I think, the big thing here is that they're really focused, and even the CEO says, on being customer obsessed. And where they're trying to deliver that value is providing different optionality, but also ensuring that not just riders are doing well and succeeding, but also their drivers too. And I think this kind of does differ from Uber's business to some extent. They have for a long time kind of been known as these more heavy capitalistic business that is trying to squeeze out every dollar they can. They're working tough hours for the Uber. And so for Lyft, on the other hand, I think they really want to focus on creating an image that is welcoming and creating an environment between riders and drivers where everything is thriving. But just by adding those kind of things and focusing on customers doesn't necessarily mean that margins are going to expand. So what are they also doing beyond just that? Well, first and foremost, the CEO said that they're looking to reduce their maintenance expenses once again this year, and that should help improve their free cash flow margin overall. But another area that they see a lot of value in is actually through their partnership plan. So what they're trying to do here is they're basically partnering up with companies like Delta Airlines, Starbucks, Disney, Amazon, and Apple, and many others, and basically trying to incentivize riders to get direct drive or rides to those places. And the CEO even mentions that about 20% of Lyft rides as of last year were actually from this direct partnership delivery or destination drop-off. So beyond that, I think that's like a huge value add overall. It's interesting. I didn't really expect, or for me personally, see that as something beneficial, but clearly with 20% of all rides going in that direction, there's a lot of value to be had, and it just provides another reason or point of differentiation for Lyft overall. So I think those different efforts, as well as really trying to build goodwill with their customers, speaks volumes. And, I'm not really overly optimistic on the ride sharing market in general. I think it's a tough business with a lot of regulatory hurdles. But I think what Lyft is doing is they're taking the right approach. And ultimately, we all know Uber is the big dog on campus. They're valued at $168 billion compared to Lyft's $7.7 billion. But I think what they need to do is really establish that, build a strong word of mouth and reputation, and offer different things. So yeah, curious from your end if you agree with that, or you think that it's going to be tough sledding and that 500 basis point never or might not never be achievable.
Well, do you ever use Lyft? When was the last time you booked a Lyft?
And good point. I've never used Lyft. I forgot to mention that. Yeah.
So I have, but very sparingly. The only time I ever
Mhm.
think to use Lyft is when Uber has surge pricing and it's cheaper to use Lyft. If if Lyft is
Right.
even like a few percent discounted, I still use Uber just because I find it more reliable. There's more cars. I've had way more negative experiences with Lyft. Like when I was down in Miami, for example,
Oh, really?
I stopped using Lyft because it would cancel on me more often than not. And for the record, anybody watching, I've never puked in a car or like smoked in a car or swore that like I've never done anything like that. Like my rating is mint. I'm a very
Yeah.
polite guest. But for some reason I still would get canceled on all the time. Um, so I just
Yeah.
had way worse experiences. So what it makes me think of, if the only reason I'm willing to go to Lyft is because it's cheaper, well, that's inherently an inferior business in itself.
Mhm.
And if you look at some of the like, I just queued up a comparison of DoorDash, Uber, and Lyft, which is they're kind of, one moves food, one moves people, one moves food and people. And first off, the only one that actually has any earnings is Uber. Um, though there is a promise of free cash flow for Lyft, which I don't think is unreasonable to think they can get there this year. Like obviously the latest quarter show that they're making the right steps to get there. They just need to take it seriously on keeping costs in control and growing the business, not spending too much on sales and marketing, et cetera, et cetera. But it is still a promise of earnings, right? Whereas Uber is delivering them
Mhm.
currently. A couple other things to look at. Return on equity for Uber is 20%. If barchart.com is correct, it's saying return on equity is negative 59% for Lyft. So it's just interesting. Now, on the other hand, though, sunshine and rainbows. Clearly, Lyft is the one that is the company for the planet and for the people. So obviously, there's something good to that. But I think the ruthless
Yeah.
business approach of Uber has exceeded the business results of Lyft in the short term, anyways. So I'm curious to see if
Right.
these more wholesome uh, initiatives pay off for Lyft in the long run. I, I'd hope so, for the
Yeah.
sake of humanity, if nothing else.
Yeah, no, I think you like brought up a really important point, and that's just the network effect associated with these businesses. So because Uber has way more drivers, it becomes a lot more reliable, like you said. And so that's probably a major area where Lyft needs to focus on is if they can bring in more drivers, make it much more attractive compared to what Uber is offering them, it'll likely increase their reliability and then ultimately the number of customers. But like you said, I like again, I have no experience as a customer with them. I've always just by default used Uber. Sometimes it's really a pain in the butt. The prices that you pay for, like I'm in deep south Calgary, away from a lot of the action that goes on, and it's typically on average like a $50 ride every single time. And it's just like, how can it like, I could take transit, but it's like, well, what the heck? That it seems like highway robbery, really, but it still hasn't changed me from looking for another option like Lyft. And so I think it's one of those businesses. The economics are not super attractive. Clearly, Uber has taken a very dominant position, and what they did really well is they scaled as fast as they could and reached a point where now they can start to charge. And because it's ingrained in our minds that they're kind of like the default option, that they can start charging a higher profit and or a higher premium as is, and people will likely stick with them. But I think Lyft's taking the right approach. It's just a matter of like, is it enough to actually change consumer sentiment towards the business? Because, like you said, if you're a potential customer and Kev, your experience in Miami, it wasn't satisfying. You're probably not going to return to the business down there or as often as is if you have that negative experience. So overall, it's kind of a game of buying customer interest, but also building enough drivers so that it can be a dependable product for you.
Yeah, so I mean, it remains to be seen what happens with Lyft. I'd say it's got a lot of upside. The fact that it moved 70% on a typo and still finished up 35% even when they revised it downward, um, it just shows how badly people want a number two. There's always going to be room for a second competitor because Uber, I mean, the strategy was brilliant. just like you said, network effects being the most important thing. Look at Google Plus, for example. It was a great app. People were excited about it. Like it looked like it could totally compete with Facebook, but Facebook already had so many users that why were you going to create something new? And Uber's got the same thing. Now, the only time Uber could start losing that advantage is when they start creeping their prices up, which they have, especially with surge pricing, where I've never seen surge pricing on Lyft. So there's always going to be room for a second. I'd encourage you, like, download Lyft. And when Uber looks too expensive, go on Lyft. It's often cheaper. So I think there's always room for a number two. But I think with being the number two, you're probably going to have worse ratios, right? You're going to be trading at a cheaper valuation. You'll probably never achieve the extended valuation that like the bigger players like Uber might get. But maybe it still turns into a good business. They've just got a lot to prove before I get too excited. So that's Lyft. Go try it out, Deck. It's worth checking it out. I'd say we made good progress today. I'm happy with the conversation we had here. Lots to watch. You brought some wicked content to us this week. So Declan, man, good to see you. Thanks for not abandoning us like Pete. I hope he's having fun golfing wherever he is. But this is fun.